While the markets react to trade and trade tariff wars, there's a sneaky economic point beginning to raise a few little fears here, and that is a flattening Treasury yield curve that could actually invert. Now, before your eyes start to glaze over, we thought we can't just throw that at you. We're going to explain why it's gotten some market watchers very concerned. Tim Courtney of Exencial Wealth and Kevin Giddis of Raymond James here to tell you what you should be doing, if anything, to your portfolio just as the so-called yield curve begins to flatten. And then maybe invert, Kevin. Explain to people why something like that matters between the 10-year, the 2-year, the 30-year.
You know, Liz, historically, as we approached a flattening curve, it really didn't matter until you inverted that curve. At that point, then you were worried about a complete recession. And we're not quite there yet. But obviously, the Fed is starting to look at this flattening of the curve. We're down to 36 basis points, 2s to 10. So it'll become a factor as we go on if the curve continues to tighten.
Can we show what the yields are right now on the 2, the 10, the 5, the 20, or the 30, just so that we can go ahead, Kevin?
Yeah, so, I mean, 36 2s to 10s, it's probably 12 or less between 5s and 10s. And so if the Fed stays pledged to raising interest rates and the market doesn't feel that inflation is going to be a big enough issue to cause them to exit their longs, plus the other external factors that are going on in the market, that flattening will occur. At some point, that flattening will turn into an inversion, and then you have to worry about a recession. But you know, for the next few months, we're going to watch it closely, and the Fed's starting to watch it even more.
Well, Tim, you've been watching this as well. Where do you put money for equities, knowing that we're getting closer with the 30-year yield at 3.05 and the 10-year yield at around, what, 2.95, Kevin? Yeah. So, Tim, what do you think?
Yeah, well, I think you need to go into places that are trading at relatively lower valuations. That's one of the things that you have to be careful for when equities and other assets become more expensive. The smallest unexpected event can throw those for a loop. And so buying cheaper, we think, makes more sense. And in that category, I think you have to throw in small caps, U.S. small caps, which when you're dealing with news items like an inverted yield curve or the dollar strengthening or trade issues, those tend to be more insulated. They have done better in recent weeks, last week being an exception, but smaller companies are trading much more attractively than larger companies, and we would expect they would do well moving forward.
Russell's at the highs of the session right now, but if you stretch that out to a 1-month or even a 6-month chart, I would think, Kevin, that he's absolutely right. We look very good. It's been a very nice couple of weeks and months for the Russell 2000 because they have less exposure to, because they're smaller, they don't do too much international stuff, so they're less exposed to any kind of trade or tariff wars. But you're looking also, I'm sure, at corporate bonds of some of the Russell, right?
You know, corporate bond spreads have been tight for the last 2 or 3 years and continue to get tighter. At some point, there's a crossover where value doesn't present itself like it did at, do you want double A's at 15 or 20 basis points over our treasuries? Are you getting paid for that risk? And the same thing is going on. It certainly has happened in the emerging market and higher yield debt market, and it's happening into the IG as well. Those spreads at some point will get so tight that investors will seek other alternatives.
Okay. And once again, we see the flattening of curves and maybe even inversion, which is that precursor, Tim, to a recession. But if Kevin doesn't see it on the horizon, do you?
I don't think so. The yield curve is one indicator, and it is flashing a warning sign, but there are other indicators showing really good strength. And I'd say the other thing that you need to note about the yield curve is we really haven't inverted at this low rate. The past 7 times we inverted were at much higher levels. And so it's unclear what's going to happen if we invert at these low levels. If the Fed raises rates to say 3, is that high enough to really cause a recession and cause a cutback? We're not sure. So I would take it with a grain of salt and watch it, but there are other indicators showing strength.
By the way, this 10-year versus the 2-year Treasury spread, you can see right before 2007, it was flat there, and that was the precursor for a big recession. Tim just mentioned what he sees as a wild card, and that could be the Federal Reserve. What about you, Kevin? What is the wild card that could affect these markets and people who are watching right now who buy stocks on a regular basis or have a 401k and a pension?
You know, the Fed themselves have remained pretty steadfast in their desire to raise rates at least one or two more times in 2018. At some point, they'll need to stop that because the effect of economic growth and if they don't get inflation follow through is where the potential for a recession could occur. So they could overcook this if they don't watch it. I don't have their inflation forecast. That is why the long end of the market is still doing quite well, but you never know.